America's financial railroad is being rebuilt. The DTCC settles every stock trade in America, and it's now running a new tokenized platform with over 50 firms, including Ripple Prime. Most observers are still arguing about prices while the track is being laid. The real question is who controls the rails, the switches, and the freight. If you're trying to separate signal from noise, stay with me. This one matters. The gap between the chart and the track. The gap between what the market is watching and what is actually getting built has never been wider. Right now, the public conversation fixates on price movements, ETF flows, and red candles. That's understandable because price is visible and immediate, and it carries emotional weight. But the infrastructure underneath those prices is getting rebuilt in real time, and almost nobody is watching the construction. Think about the transcontinental railroad in the 1860s. The real investment thesis never revolved around the price of steel rails or the cost of locomotives. It revolved around the volume of freight that would eventually move across the network, and the economic transformation that came from connecting regions that had never been linked before. The value sat in the right-of-way, the stations, and the contracts that locked in access before the track had even been finished. Speculators who traded steel contracts pocketed or squandered small fortunes in the short term. The operators who controlled the route captured the real value for decades. Most retail traders are still watching the steel. When we talk about settlement architecture, we're talking about the invisible plumbing that moves cash and securities between institutional balance sheets. This isn't trading, and it isn't price discovery. It's what happens after the trade is executed, when legal ownership must transfer, cash must move, and risk must be discharged. The DTCC alone custodies roughly $114 trillion in assets, and the annual transaction volume is measured in quadrillions. Every stock trade, every government bond, every ETF in the United States flows through this system. The infrastructure hides in plain sight by design. You never see it, but nothing works without it. Right now, that system's getting upgraded from the inside in ways that don't show up on a price chart. Over the next few minutes, we're going to look at three things. First, how the old rails actually work and where the friction lives. Second, the new track being laid by the DTCC and where Ripple Prime fits into the construction. And third, why the architecture always matters more than the price of any single asset that rides on top of it. How the old rails work. To understand why the new track matters, you need to see exactly how broken the old rails are. The old rails aren't broken because someone designed them badly. They're broken because designers built them for a world that no longer exists, one where information moved slowly, and trust required an intermediary at every step. When a bank in London needs to send a payment to a bank in Tokyo, it doesn't happen directly. The London bank maintains a Nostro account at a correspondent bank in Tokyo, pre-funding that account with yen so that payments can clear during Tokyo business hours. That correspondent bank might then rely on another correspondent, and that chain can stretch across 3 or 4 institutions before the money actually arrives. Each link introduces reconciliation burdens, compliance checks, cutoff times tied to local operating hours, and fees that are opaque to the sender. The BIS has documented how these arrangements produce long settlement times, fragmented liquidity, and costs that hit smaller institutions and emerging markets hardest. Banks must hold idle balances across multiple currencies and jurisdictions, and they're exposed to the creditworthiness of every correspondent in the chain. This is the world of swift messaging. It's not a settlement system, but a messaging layer that tells banks what they owe each other. The actual settlement happens later across separate ledgers with manual reconciliation in between. That gap between message and finality is where settlement risk lives. You have 2 counterparties, 2 systems, and a window of time where each side has fulfilled its obligation, but the other hasn't yet confirmed receipt. Distributed ledger technology doesn't eliminate risk entirely. What it does is compress that gap towards zero, and that compression is what changes the economics of the entire system. That same gap shows up in securities markets, but in a different form. When you buy a share of Apple, the trade executes in milliseconds on your broker's app. The actual transfer of legal ownership and cash settlement takes 2 business days. During those 2 days, counterparty exposure persists. Margin requirements are calibrated to multi-day windows. And the system relies on omnibus accounts at central depositories where end investor entitlements are recorded indirectly. It's well understood, legally entrenched, and deeply integrated into every bank's treasury operations, risk models, and compliance procedures. That's why replacing it is extraordinarily difficult. The network effects are massive. The regulatory precedent spans decades, and unilateral moves by a single jurisdiction risk creating innovation pockets that don't connect to the broader system. The legacy rails weren't built to fail. They simply weren't built for the speed and connectivity that modern markets demand. You don't replace a railroad while the trains are running. You lay a new track beside the old one, and you let the engines switch gradually. That's exactly what the DTCC is doing. The new track, Project Ion and Ripple Prime. Project Ion is the DTCC's version of that incremental approach. Project Ion is a DLT-based parallel book that mirrors bilateral equity deliveries between DTC participants. It doesn't replace the classic settlement system, but runs alongside it, recording the same activity on a distributed ledger, while the legacy system continues to handle legal finality and transaction processing. In its current minimum viable product phase, Ion is logging over 100,000 bilateral transactions daily and up to 160,000 on peak days. That's not a theoretical test in a sandbox. It's live production data pulled straight from the actual market. The design is settlement time agnostic. It supports T+2, T+1, and netted T+0 cycles. It isn't built for atomic real-time settlement yet, and that's deliberate. The DTCC is prioritizing compatibility with existing netting and risk management structures over flashy headlines about instant settlement. This is the posture of an institution that knows it can't afford to break the system it's trying to upgrade. But a platform without participants is just an empty track. In May 2026, the DTCC advanced its tokenized securities platform and convened a working group of more than 50 firms to drive adoption. The participants include BlackRock, JP Morgan, HSBC, and Ripple Prime. This isn't a partnership press release or a crypto influencer tweet. It's a live working group where the standards for tokenized securities settlement are getting written. Ripple Prime is there because Ripple acquired Hidden Road, rebranded it as a prime brokerage arm, and by March 2026 had secured a live operational listing on the DTCC's NSCC directory. That's a cleared position in the infrastructure, not a speculative narrative. Now, we need to be precise about what this means and what it doesn't mean. Ripple Prime is in the room as an institutional infrastructure participant. Whether the XRP token itself will directly settle transactions within the DTCC tokenization service isn't yet confirmed in primary sources. What's confirmed is that the company behind the XRP ledger is embedded in the core infrastructure of American capital markets at the exact moment that infrastructure gets redesigned for a tokenized world. That distinction matters because the architecture matters more than the speculation. Being in the room where standards are written is a structural position. Whether the token becomes the settlement asset inside that room is a secondary question that will be answered by operational metrics, not by narrative. And that's a structural signal, not a price signal. Ripple's on-demand liquidity service operates in a related but distinct space. It uses XRP as a bridge asset to source liquidity at the moment of payment, which eliminates the need for banks to pre-fund Nostro accounts in every corridor they operate. The institutional relevance of ODL depends on whether it genuinely reduces treasury costs and friction for banks and payment providers, and how it performs under regulatory scrutiny over time. That's a separate question from Project Ion, but it points in the same direction. The old model requires idle liquidity parked across dozens of jurisdictions. The new model asks whether a bridge asset can do that job more efficiently. If it can, the value proposition isn't about the price of the bridge, it's about the volume of freight that crosses it. Why architecture beats price. So here's the real question, and it's not where most people look. With the tracks being laid and the engines getting tested, the value doesn't land in the price of steel. It lands in the control of the route. In the 1860s, the railroad companies that captured the most value weren't the iron mines. They were the operators who owned the rights of way, set the schedules, and collected the tolls. Settlement architecture works the same way. The long-term winners come from the entities that secure regulatory trust, integrate with central bank money, and establish the interoperability standards that other participants are forced to adopt. There's a critical distinction here between a speculative token and a utility-driven asset. A speculative token earns its value through expectation and narrative, while a utility-driven asset earns its value through use. If you can access a protocol's core function without ever touching the token has a utility problem. That's a structural question, not an opinion. When we look at XRP in the context of on-demand liquidity, the question is whether the asset is required to move value across the network. If the bridge functions better with XRP than without it, the utility case strengthens. If workarounds emerge that bypass the token entirely, the utility case weakens. The architecture will determine the answer, not the marketing. That's the kind of question infrastructure analysts ask, while speculators argue about support levels. Policymakers are asking the same question across multiple jurisdictions. In Europe, the Association for Financial Markets in Europe has laid out a detailed vision for DLT-based capital markets architecture. The priorities break down into 4 parts. First, bring central bank money on-chain through initiatives like the Eurosystem's Pontes project. Second, make DLT-based securities eligible as collateral so they can be used directly in repo, margin, and central bank operations. Third, establish protocol-level interoperability standards so assets can move across ledgers without fragmenting into silos. Fourth, build a 2-tier banking system on DLT that brings commercial bank money on-chain for asset managers and corporates. These aren't technical wish lists, but the prerequisites for scaled network-based platforms to move from experimentation to production. Europe is laying out the blueprint. The BIS is testing whether that blueprint works across borders. Projects like mBridge connect economies through central bank digital currencies designed to interoperate across jurisdictions. The goal aims to enable cross-border settlement without the correspondent banking chains we discussed earlier. Finality has already launched live sterling payment operations using a tokenized representation of funds tightly linked to central bank money. These aren't pilots in the sense of exploratory experiments. They're production-grade proofs that the model works. And when multiple central banks, clearinghouses, and private consortia are all converging on the same architectural direction, the signal isn't speculative. It's systemic. The investment implication is straightforward. And it's not about picking a winner based on price momentum. The infrastructure winners will likely be the entities and protocols that achieve regulatory trust and deep integration with central bank and depository functions. Speculative token valuations may or may not mirror that rail dominance in the short term. That's why the railroad analogy holds. Investing in the railroad doesn't mean trading steel futures. It means understanding which route becomes the default. Because once a route is the default, the economics of switching become prohibitive. Reading the signal, which brings us to the part almost everyone misses. The installation isn't coming, it's already happening, and the calendar isn't theoretical. The DTCC has announced limited production trades involving tokenized securities in July 2026, with a full-service launch planned for October 2026. The service will cover select DTC custodied assets, including equities, ETFs, and U.S. Treasuries. Ripple Prime is already listed on the NSCC directory, which means it has cleared the operational requirements for integration with the core clearing infrastructure. These aren't milestones on a whiteboard, but live operational facts that you can verify from primary sources. The gap between institutional behavior and retail sentiment creates the analytical edge. Institutional capital tends to flow toward infrastructure upgrades and regulatory clarity. Retail sentiment tends to chase price and narrative. When those two diverge, the price chart becomes a lagging indicator of a structural story that's already further along than the market realizes. The people who understand the difference between a pilot and a production deployment are watching a different set of data than the people watching candles. That difference is the edge. Builders are augmenting the legacy rails, not dismantling them. Project Ion still runs parallel to the DTC Classic system. Ripple Prime sits in the working group alongside the largest financial institutions on the planet. Regulatory frameworks are shifting from enforcement-driven uncertainty toward rulemaking, which is the environment where infrastructure gets built rather than debated. The marathon is already underway, and the early miles don't show up on a price ticker. You can find the signal in the permits, the land purchases, and the track being laid. The noise sits in the daily price, what to actually watch. So if you're not watching the chart, here's what to watch instead. The first signal is the DTCC tokenized security trades scheduled for July 2026. Watch whether the limited production expands as planned, or whether the timeline slips. If the working group firms increase their participation, the momentum is real. If the timeline slips, the friction is greater than advertised. The second signal is whether XRP finds growing use as a bridge asset or liquidity tool across institutional platforms. If the asset becomes embedded in settlement and collateral workflows, the utility thesis strengthens. If alternative assets take that role, the bridge may be optional. The third signal tracks regulatory clarity progression. Watch whether the legal framework for DLT settlements solidifies across jurisdictions or fragments into incompatible national standards. Solidification favors network effects, fragmentation favors silos. The railroad keeps getting built. The question comes down to whether you're watching the steel or the map. If this kind of structural analysis is useful to you, subscribe. This channel is built for exactly this type of research.